Hello, welcome to Dissident Canada. My name is Tyler. New setup today. Going to go over some charts and such to talk about what's actually going on with the dollar. As you can see in front of you is the US dollar index, also known as the DXY. And this appears to paint a very grim picture if we look at the year to date. But if we have some perspective and we click all time, we're still quite relatively high. So, what is going on? Well, there's a persistent narrative that the dollar is dying, and that when the dollar goes down in value on at least the DXY, that means the dollar is dying. And it's not so true. What's really happening when you have the dollar go down is instead of de-dollarization, you have re-dollarization. Because of the way the euro-dollar system works, it means dollars are cheaper for more people, and seeing as dollars are inputs at some point along the line for everybody, everybody goes and runs out and grabs more dollars. As you can see in the run up to 2008, you have re-dollarization as it gets cheaper, and then at a certain point you get the spike. The system breaks, goes down, and then we're going through cycles all the way over here. So, what is actually going on in the system? Well, if I go over here, earlier in the year, what we were seeing, we were looking at the US Treasury yield curve, very important curve to keep in mind when talking about the dollar. The red line is the beginning of the year, and the blue line is the 8th of July. So, the red line is lower at the far end of the curve and the short end of the curve, and higher in the middle, but still massively, fairly inverted. But now we have the far end of the curve being higher, the middle of the curve being extremely inverted, and the low end of the curve being slightly higher of where it was. So what happened is earlier in the year, with Donald Trump's Liberation Day and just the tariff nonsense in general, I do have a video about this if you want more detail, but what happened is the long end of the curve was being sold off so that holders could acquire dollars, swap those dollars into their local currencies, and pay off their local currency debts, is most likely what was happening. It was a deleveraging play. And you could tell that because as the yield of the long end of the curve was going up, the dollar, give me the 6 month, was, it was continuing. Well, it's in these spike zones. It's when you had the dollar going down in consistent time. So the DXY measures the dollar's relative value against a basket of currencies, predominantly the euro and the yen. So when you have dollar going down and those relative currencies going up, with in conjunction of the long end of the yield curve going up, you have mechanically what's going on is you have people selling the long end of the curve because it's very, very illiquid. The only people who have to have them are certain types of banks and pension funds, and that's required by law, so they have to have them. Then that's basically the market. Anybody else kind of just sits on them and waits when they can bail. So you had the bailing on the long end of the curve. It spikes. Wrong one. Dollar goes down, and those relative currencies go up. Now, if we look at what's going on now with this second wave of tariffs, we have something slightly different. Let's get rid of, go to today. Now we just have one line to contend with. So yields, wait, yeah, see, yields have risen in the last few days. So yields going up, but dollar index is going up as well. So we can conclude that people are not, or at least the major players are not selling the dollars, they're sitting in the dollars. And if we look, the middle of the curve, specifically the 10-year and the 7-year, have, oh wait, they've risen. Yeah, everything's rising. So people are sitting in dollars. They're holding the dollars. The dollar isn't dying and it's not spiking yet. It most likely at some point will spike, but this is the mechanics of what's going on with Trump's tariffs and such. But the real problem we're going to see, and why I am slightly worried, even with this hiccup of the dollar going slightly higher. Remember, it's slightly, like we were sitting at, looks like the low point is around 96.82 on the DXY. So that's an extreme low point for what, like the last couple years. Since, yeah, say sometime in January of 22. And if you look, the dollar hit a low point in the just high 80s. And then over time, it spiked. And remember what happened in 2022? We had that supposed spike of inflation. Wasn't really inflation, it was the mechanics of low supply and dollar going up. But you had this re-dollarization period. The debt starts to come due. You have the scramble for dollars, but there's no real new credit being made to pay off old credit. So you get this breakaway. It's very similar to what happened, again, in the lead up to 2008. This is all re-dollarization. Spike system, has its crash, and this is our recovery phase. That's all playing out at the same level. Now, we probably won't see the same lows of the lead up to 2008 because of the mechanics of the euro dollar and the dollar milkshake theory presented by Brett Johnson. Each I can't speak. After each crisis, the lows of the dollar will be much higher than the previous because you have, outside the United States, an ever-increasing amount of dollar-denominated debt. So it just puts a limit on what the low is. But the lead up to that spike, you'll see a dip, and then the spikes to the high end will be higher and higher and higher. As if we go there, we see since 2008, it is very much drifted upwards. Now, we haven't seen the massive highs here of, what was it, probably hit, yeah, just about 120 on the DXY, and there was some other shenanigans there. But we're steadily drifting higher as again like since 2008 you can see this. Now obviously post 2020 we have some serious problems due to government malfeasance and interference in every system imaginable, so it's kind of hard to tell right here what the fuck's going on. But there are things going on. So, we're in this re-dollarization period. If we look here, this is the Canadian US dollar trade on the 5-day chart. It looks very, very gloomy for the Canadian dollar, doesn't it? But, oh, please load. I'm trying to get the all-time. Hello, please load. Give me. There we go. See, if we look back to what happened in the lead up to 2008, and you compare that to the DXY, you have the dollar going down, the Canadian dollar going up. Then you have the inverse of the graph. You have a spike and then down. So, if we're going to make a guess or, predict the future, if the DXY continues to go down, the Canadian dollar will then reset its trend that it has on the last 6 months of upwards, general upwards. And then when we have our dollar spike like we did here in 2008, we will have a crash that corresponds. It probably won't be one-to-one because there's a lot of things that go into the price action. And then afterwards, we'll see what we had again, which is the Canadian dollar going up. Which is why, again, I think, the next couple years, maybe not this year, but like if Donald Trump can work out his whatever he wants to do with trade tariffs, that goes back to normalizing. We could see again what happened here. The Canadian dollar I don't know if we can get to exactly, dollar for dollar with the USD, but we can get pretty close. My guess is we get somewhere right here, like 80 to 85 cents to the dollar, which would be very good for a trade with the United States. And considering most of our import costs are in dollars, even if we don't, again, get from the United States. Then, we'll have the dollar spike, so the Canadian dollar will go down again. But then in the ensuing chaos, we'll see this most likely. And then when everything starts to level off, trade sideways. So my plan has always been to take advantage of what's happening right here if this plays out again, because what you can do is load up on Canadian dollar assets, sell them at somewhere around here, and then buy American dollar assets, and when CAD goes down, you sell them for Canadian dollar assets, so you get more Canadian dollars. My plan is then to sit in like treasuries, like in Canada we call them maple bonds, the short term, the shortest term of the Canadian yield curve, bond yield curve, and then wait for the Canadian dollar to go back up and then swap. So I have basically arbitraged this, but with assets. That is my plan. If it, works out and plays out that way. But yeah, like the dollar is not dying whatsoever. Like if the dollar were to die, okay, let's get rid of this. Because this is a debt-based monetary system, For the dollar to die, there would have to be credit, either defaults or massive payoffs of one paying off their debt. So what that means is you now have less circulating supply, less dollar creation, because they're de-dollarizing, so they're not re-upping their credit, but you still have the relative same amount of demand domestically, because that's what's important in this calculation too. So instead of going down like it is here, you would see a massive spike in de-dollarization because supply is being limited, but relative domestic demand for dollars, so inside the United States, is up. So if you see the DXY massively start spiking, all right, then you can make a reasonable conclusion that something is going on and there is a small bit of de-dollarization happening. Now, again, the mechanics of the euro-dollar system slash network kind of means that you're always going to see, again, on this long end of the curve, re-dollarization, de-dollarization, re-dollarization, de-dollarization. Like the spikes will continue eventually until like this yield curve starts to massively spike when you say you've got, let's just say that the Fed funds target is the same, so somewhere between 4.25 to 5.5 points. If the entire curve, all right, from the 1 month to the 30-year is, say, somewhere between 6 to 10 points higher than that, so that would be at the low end, 6.25 to 14.25 points total. Like that's their yield. That's their percentage yield. Then you can say, okay, we're having some very bad shenanigans go on, and we may be seeing de-dollarization. But you could also be seeing, just as Brent Johnson calls it, the what does he call it? He calls it the milkshake theory, which is basically euro-dollar endgame. And the reason why the yields spike is because everybody needs so much dollars, they pile into treasuries and are just constantly selling them to get the dollars. So, like, nobody's going to hold them on long term. They're just buying them, getting a coupon payment or two, and then selling them, taking their dollars and moving on and paying off their debt, which, spikes the dollar. So, if we look here at oil, oil is also setting a higher trend again, which it really shouldn't be. There's not much demand, but this is only the 1 month. Yeah, always put things in perspective. We're still probably going to continue to the down. We're just in one of these spikes. Anyways, that is the video for today. Some spotlight of what's going on in the dollar space and related to the Canadian dollar, because this is Dissident Canada. May as well talk about that and talk about the U.S. Treasury yield curve, because it is extremely important thing to know about and to keep an eye on, because it allows you to make fairly accurate judgments of what's going on in the monetary system. Like if you look down here, why is the 1 month so low? Or yeah, so low compared to the fact that, you could go, because the 1 month keeps dipping way, way, way down on the intraday. Like it keeps like dipping down here, where you could just go and put your money into the Fed's overnight repo program and get a higher yield. Anyways, that's probably best left up to Jeff Snyder, which he was talking about the other day, so you can go check that out. Until the next video, have a good day. Oh, it's a white pill edition. I guess I gotta find something relatively good that happened this week. Oh well, that's on me. Until then, have a good day.